Bankole, thank you so much for joining us today. Of course, the big news this week was the MPC's decision. It was, to a large extent, a surprise decision with the rate cut we saw. The big question is what happens next. So can you just give us your thoughts on that? The likely impact of the MPC stance towards interest rates moving forward, especially in the context of the fixed income market.
Thank you, Wole. It was indeed a surprise, as most observers and participants in the market thought that an attempt to shift the rate either upward or downward would actually be done probably at the last MPC of the month, which is in November. But the central bank, the Monetary Policy Committee itself became proactive in view of the impending recession and decline in growth of the GDP of the country. It's apparent, it's clear. We've seen two major drops already in figures released for first quarter and second quarter, and it looks as if it is imminent that there could be a further negative growth in the third quarter figures when they are released. I believe that when those figures are released, it will be coinciding with the last MPC meeting of the year in November, about November 22nd or 24th. When this happens, it is possible that there could be further review of monetary policy rates in consonance with what is going on in the market already. Rates have declined and depressed simply because of restricted or limited amounts of instruments being issued right now. There are major concerns concerning cost of debt, not just debt in itself by way of amount. No, the cost of debt, which used to be over around 10 to 13% before. But right now, the Debt Management Office is issuing fresh, reopened 2026 bonds at 6%, and the long-term bonds 2045, 2050 at 8% yield. This is what we think. The Debt Management Office and the Ministry of Finance will be trying to take advantage of this. Further, so it's not a coincidence. It's a deliberate attempt to reduce interest rates for borrowing. That's for government on one hand, and for businesses, the real sector, who have complained bitterly over the years of lack of credit instruments or facilities and lack of cheap credit.
Right. If we can move away from the fixed income market for a moment, I wanted to get your thoughts on some dynamics we're seeing in the forex market. So I'm reading that the external reserves have been rising, albeit slightly, but at the same time we're hearing reports that the central bank is restricting the list of items that are eligible for foreign exchange. Indeed, I was speaking to someone recently, and he's saying that foreign exchange is an extremely scarce commodity right now. Trying to get forex to fund some transactions, it can be very difficult in these times. So first of all, just your thoughts on what that could mean for the short-term outlook for the exchange rate. If we're seeing such restrictions, what is likely going to be the impact on the exchange rate moving forward?
Okay, the focus of government is now shifting to funding. By way of funding, I mean selling FX to materials or items that qualify. These are items that or services that are not readily available within the country. It seems as if there's a rethink at the strategic level of governance that Nigeria had in the past been selling its foreign exchange earning export proceeds cheaply. And given the demand that has arisen from this, what they are trying to do right now is to ensure that we source locally, that is government in itself and the real sector, we source locally made products, milk, lactose products, and other food items in general. The central bank is still intervening in the market, even through the BDC, twice a week, reducing from 4 times a week, and then the amount reducing from $5,000 to $20,000. But we believe that's just at the moment. As the global economies open up some more and people begin to travel some more, we expect them to sell more travel allowances, and then even to sell more to the change. The external reserve may be inching up, like you said. Fine, it's not an account balance, but on the average, what's happening is that the central bank is reducing and shedding off the bills it's taken in for items and resources that could be sourced locally. It's a rethink at strategic level, and you can see that fuel subsidies have been removed, power subsidies have been reduced, and other fiscal moves also to ensure that government revenue is propped up and that dollar is sold to the right customer sectors, and that these dollars sold are also to the legitimate customers who need them. We've seen attempts of late from the central bank to ensure that middlemen who come with Form Ms will not be allowed. The customers directly are encouraged to approach banks to source for dollars, and they will get them in due course. So basically, that's what happens. So we think at the strategic level of governance to manage the country's FX earnings more prudently.
Right. But what do you think that all that means for the exchange rate? Very quickly, if you can.
Well, the demand still outweighs the supply, and then we are seeing a gap in the parallel market compared to where the central bank is. But it seems what they are hoping on is that somehow external export proceeds will increase with time as the global economy recovers from COVID-19, and then we'll be able to bridge that gap. I believe that's their view. It's just a matter of time they'll be able to bridge that gap. Whether that happens or whether that is possible is a different story entirely.